So the context of today's discussion is around blockchain, definitely a buzzword for good and bad reasons, I guess, right now. And my focus is really on integrating blockchain with the built financial system and what that means from a regulatory perspective. As noted, my focus, especially in the last several years, has been on transaction monitoring for AML, anti-money laundering purposes, although there's a lot of overlap with sanction screening, with know your customer, etc. And we'll touch on all of those in today's session. The first point about blockchain and its integration or non-integration, as the case may be, is that it's really a totally different type of technology than anything we use in the financial sector, the major institutions today. So that creates a lot of practical and technical challenges. The first main point is that blockchain is self-contained. Yes, we know that there are many different ways that blockchains can be built out and used, but essentially they are self-contained so that all the different types of validations that we do around any sort of transaction activity normally to meet regulatory requirements won't work with blockchain. They can only be applied through pretty onerous workarounds. So that means it's a totally different paradigm when we're looking to build out financial monitoring programs. Another point, and this, I think the advantage kind of goes to the blockchain world, is that in most financial institutions, there are a lot of silos between AML monitoring, anti-fraud monitoring, sanction screening, know your customer. And it's pretty typical for totally different systems to work on each of those areas, even though there is, from a risk-based perspective, a lot of overlap among them. That said, on the blockchain side, basically everything is pulled together at the same time. So that's more elegant for blockchain, but we still have to figure out how we marry those two approaches. So a lot of fundamental questions have to go into any considerations around building out a financial monitoring program with regard to blockchain transactions. When we're talking about the build out of technological solutions, we typically start with the data. And no matter whether we're talking about machine learning or automation or any type of implementation, most of the work is spent upfront, or at least a sizable portion is spent upfront taking care of data-related issues. In this case, to marshal the data that's required to feed into the solution, you have to have blockchain or on-chain data. But the historical financial institutions do not have this data. That's not surprising. They haven't been working in this space for very long. A lot of the interest is pretty recent, and the ability to implement technical solutions on top of it is even more recent. So that requires a situation where financial institutions need to rely on new fintech firms who are proliferating in this space. That in itself is not necessarily a challenge because all of the major financial institutions use multiple vendor products for anything and everything. But one particular challenge here is that even if you do your due diligence, go through a lot of fintech firms that work in the blockchain area, you'll find that their coverage can vary pretty drastically, whether it's from a perspective of geographic coverage, entity coverage, different blockchains and cryptocurrencies and other related assets that are covered. So the typical approach right now is actually to leverage multiple vendors in the hope that you can get sufficient coverage, and at a minimum, you'd be looking to address the locations and the types of activity that your clientele will address. So that's a minimum. So that means that there has to be a fairly complex set of vendor solutions. And then the other piece of it is connecting the so-called on-chain data to the off-chain data. So in older speak, off-chain data is all the customer and transaction data that a financial institution will have accumulated and or will get exposure to through the processing of financial services. So here we're talking about entity resolution, being able to understand what an entity looks like on the chain versus off the chain. A lot of the vendors in this space are increasingly able to link digital wallet addresses, for example, to real world entities. But that's still a really complex calculation, including because even financial institutions today have a lot of challenges around entity resolution, whether it's a complex structure that involves subsidiaries with multiple names or name combinations, or whether it involves entities that have associated parties or beneficial owners who are linked to them. So this just further complicates that whole issue around understanding who's on the other side of a transaction. So when we're thinking about how we meet the regulatory requirements for financial monitoring, which I'll talk about this a little bit more in a few minutes, but these are not particularly well defined. The initial instinct is to try to replicate what's been done already for other types of assets, even as challenging as that may be. And there's a lot of inconsistencies between jurisdictions as well. So this is a complex, unique problem. So the first thing you want to look at is defining what the risks are. If we're talking about money laundering, essentially any sort of financial crime will ultimately fall under the rubric of money laundering, under the concept of a predicate crime. So anything that is a crime that has interaction with the financial system, you have money laundering. That said, in the blockchain space, a lot of the frauds and other types of financial crimes are very specific to this type of technology and to the types of institutions that grow up and around this. So different types of exchanges, different tools that take different cryptocurrencies, mix them, slice and dice, make them fungible from one system to another. So you're looking at a whole different risk area that a lot of people who are already in this space are probably not too familiar with. Then when we're talking more about sanction screening, in some ways this is more straightforward because for sanctions, you're looking at a list of people or entities that have violated laws and gotten on the negative list for various US institutions, EU institutions, technically any country or multinational quasi-governmental body can have these lists, and there are lots of vendors that have amalgamation of these lists. Those are very typical products that are used by any financial institution. However, when we're talking about blockchain, the only real data point we have is the digital wallet address that is used to transact on the blockchain. And going back to that data question, you have to be able to link the individuals or entities behind a given digital wallet address, and all of those vendors that have copious numbers of sanctions lists that are collected globally and that are updated constantly because they're always changing. Most of those don't really have built out capabilities with regard to digital wallet addresses. So maybe you can use some of your internal tech to try to link wallet addresses and entities. Maybe you can leverage that from vendors that you've hired. Then you're still going to have to look at what do I do if there is some kind of indirect link? If you know that a certain wallet address has been sanctioned, that's very clear cut. And also the matching is pretty basic because either that long string of letters and numbers is on a list or it is not. But if you get information that that wallet address has potentially been linked to other wallet addresses that have suspicious activity or other entities that have engaged in certain types of frauds, you're going to have to make a determination how closely related those activities need to be in order to count as a hit for sanction screening purposes. And this can get tough if we're talking about the use of exchanges or tools that mix a whole bunch of entities and wallets and currencies together. So a lot of key risk definitions need to go into how an institution protects itself from this type of sanctions risk. Then similarly, with regard to travel rule compliance, this is the requirement that transactions over a certain amount have identifying information accompanying them. This is the basis of a SWIFT system, for example. This is all built into today's financial plumbing, but not blockchain. There's no space in the blockchain for this data, so everything has to be a workaround. And this requires the financial institutions on either end of a transaction to have some level of coordination to share this information. First, they got to confirm that they have the right wallet addresses, that they are connected to account holders, and that they have confidence sharing data about those account holders and their transaction activity with other financial institutions. So in the blockchain world, these institutions are virtual asset service providers, or VASPs, and there are a handful of so-called protocols that have been set up, and there are different financial institutions, both from the so-called fiat world and from the new fintech world, who belong to each of them. But right now, there's no one dominant protocol or system that has been set up. There's patchy coverage. There is immature adoption. Certain jurisdictions require all transactions to be pre-cleared, like Singapore or Switzerland. But most don't even have regulations around this yet. So a lot of really institutional challenges around what we would consider normal compliance for financial monitoring. And all of this is taking place in a very dynamic, volatile environment. The blockchain area has, maybe since its inception, had a reputation of being high risk. I think that's certainly been exacerbated in very recent times, but not just recent times, because over the years there have been multiple scandals, frauds, thefts, law enforcement identification of the use of blockchain and cryptocurrencies to commit multiple types of crimes, not just financial crimes. So that's, from a regulatory perspective, that's the impression going in. And then, with the collapse of FTX, that was very recent, I think it's probably really accelerated the drive toward more regulation and more closely matching regulation for the fiat world to the blockchain world, even though, as noted, the underlying technologies are really different. So we've already seen a lot of regulatory uncertainty, evolution of the regulatory approach, and I think in many ways the FTX collapse has solidified that the future will be a lot more stringent regulations. And so all the challenges that I've called out around the underlying technology, the data that's required, the risk analysis that's required, it's going to put more and more pressure on all of those areas. And we've also seen a lot of big fines, actually, mostly for fintech companies that are involved in this. And so it's been a very rocky transition to go from cutting edge technology in fintechs meeting the, let's say, reality of the heavy regulation of the established financial sector. And echoing some of those themes, I would call out that there are real culture issues here. So as people are probably very well aware, the origin of blockchain It has a heavy emphasis on privacy, anonymity, security of the transactions that you make. But while privacy and security are very important considerations for regulated financial institutions as well, the way they get at it is really different. And certainly we'd start on the financial regulation side with very heavy centralized control that goes directly against any sort of idea of decentralization. And then there's also an inherent technical mismatch, even within the blockchain world, because while transactions are supposed to be secure, unchangeable, whenever you're interacting with real world finance, you have to create exchanges which are technically outside of the blockchain. And in fact, a lot of the billion-dollar frauds and scandals have been associated with exchanges, which are not technically on the blockchain, but they're necessary in order for people to have accounts, to interact between their fiat currency and their digital currency, to be able to use different cryptocurrencies as part of a financial portfolio. So all of these necessities to bring the blockchain world into a regulated financial system really create some tough questions around the use of that underlying technology and the institutions that have grown up around it. I'd also like to talk about how we support these areas going forward. So right now, there is, I'd say, a rush within the established financial sector to build out digital blockchain capabilities. There's a real focus on transactions, transaction processing, payments, but there's interest in more than that, different types of assets, tokenization, different types of securities, contracts going forward, loans, etc., because both individual and institutional clients are really looking at this sector as a necessary part of future portfolios. So there's a lot of pressure to move forward in this area. That said, there aren't a lot of people who have experience working in this area. That's because it's new. That's because it really originated from somewhere very different from where a lot of the people who come into the typical financial sector come from. And this culture clash I was talking about, on the one hand, you really need the avant-garde, hot tech, innovative, creative sensibility in order to make sense of the new world. And then on the other hand, you really need those old school compliance people who understand risk, understand the different parts of the financial sector, how they fit together, how you can efficiently and effectively use different tools and techniques to protect yourself from regulatory risk, and also to protect your clients, to protect your financial institution, the broader financial sector as a whole. So I think the really obvious answer here is that you need both of those. There are lots of challenges in combining them, and that's beyond the underlying technical data risk challenges. So that's really a tough challenge, limited pool to pull from, and really asking a lot. But at the same time, it's a very exciting area of development, notwithstanding the most recent scandals. And also, I think the price of admission, you might say, has risen. Maybe even as, as short a time as 1 or 2 years ago, entering into digital or blockchain asset world wouldn't have had as much scrutiny maybe to kick off. But now, after multiple big fines, after multiple big failures, I think anyone is going to have to look really carefully at making sure that you have all your due diligence and compliance setups in place before you even think about going live, because the risks are well known, they're well publicized, and I think it'd probably be considered irresponsible to move forward without addressing them effectively. So I don't want to be too negative in calling out the challenges, but these are all really significant challenges, and there are various financial institutions that are in different phases of addressing them effectively, and I think we'll probably start to see more and more of this availability, probably starting first with more popular assets such as Bitcoin or Ethereum, and then branching out later. But really different perspective given recent events that have exacerbated some of the known challenges in the past. Okay, I think we have about 5 minutes if there are any questions or comments from anyone who's in the session.